Commercial rent collection. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee because we're going to have a look at an article from commercialrealestate.com and originally from the Fin Review discussing GrowthPoint's 2021 payout guidance. And well, this gives us an insight, I would say, into at least a portion of the commercial real estate market and how that sector is going, at least with paying their rent on time. I think it's important, particularly for everything that's happening in the economy around and just the cultural shifts that are going to move, that are starting to materialize with us all working from home and working remotely. Now, the reason I think this is interesting is if we jump over here, this is the Property Council data room, and let's have a look at just office spaces here. Once it loads up, come on NBN, you can do it. Okay, and here we have a look at office vacancies, and you can see here in Australia, it's right now, we've got a 9.2% vacancy rate, and it's ticked up. You can see this spike here, you know, from going up from 1990 and to peaking at about 94, 93. That's the recession Australia had to have. Now, a lot of people invest in commercial property because they believe it's a safe way to get a dividend, safe way to get a return. We can see it's spiking up now in Melbourne and in Sydney. And in Brisbane, it's climbing up a little bit, not as dramatic. Adelaide, it's pretty high in Brisbane anyway. It's going up. Perth, it's lifted up since 2012. It's going up slightly. Good old Hobart remained flat. But look at that spike. You can see that recession, everyone. You can see that recession. Good old Darwin. And Darwin, as you all know, didn't exist until January 2010. They're all paid actors that weren't put on, weren't put on the payroll until then. But we won't let the Americans know that. But you can see there, it's flat at the moment. But then everyone's favorite city, good old Canberra. There you go. There you go. But even there, they're actually going down. It's gone down. So we can see as well, office demand for Australia has gone up in different cities. Sydney is down. Melbourne has shot up. Brisbane has shot up slightly. Let's jump at Canberra. You can see there as well. Then the office development pipeline. This is going to affect the construction sector, everyone. This is going to affect the construction sector. Then property returns by index, total return. We can see offices capital growth. This is to June. Retail, it's taken a hit. And industrial has gone up in everything. Retail's taken a big hit. So why are they looking at GrowthPoint? Why are they looking at GrowthPoint? So we can jump over here and we can have a look. This is their website. Let's go to their about and see who they are. What's GrowthPoint? GrowthPoint provides spaces for people to thrive. For more than 10 years, we've been investing in high-quality industrial and office properties across Australia. Today, we own and manage 58 properties valued at approximately $4.2 billion. We actively manage our portfolio. We invest in our existing properties, ensuring they meet our tenants' needs now and into the future. We're also focused on growth and growing our property portfolio. We're committed to operating in a sustainable way and reducing our impact on the environment. GrowthPoint is a real estate investment trust, so an REIT, listed on the ASX and is part of the S&P ASX 200. Moody's has issued us with an investment grade rating of Baa2 for senior secured debt. So their portfolio value is $4.2 billion. Their weighted average capitalization rate is 5.7. The weighted average lease expiry is 6.2 years. Now this is important when you're signing up a commercial tenancy or even a retail tenancy. The valuation of their assets here, their portfolio, is dependent on, by these two factors, among other things, but their occupancy rate and how long it is till the lease expires. So if they sign you up, and I learned this after doing it the hard way, was that, they gave me an extra month free to sign up for another 3 years. And I thought, oh, fantastic. And I didn't really think about it too well. I didn't understand what I was signing up for because I was making them money just by signing that piece of paper. It was worth a lot more than 1 month. But look at their occupancy rate. It's at 93%. And how they differ, 100% investment in Australia. So it's an Australian REIT. Have you invested in GrowthPoint, guys? Let me know. Let me know. It'd be interesting to see. They're a close relationship with their tenants and they're income focused. Our aim is to provide security holders with sustainable growth income returns. We do this by maintaining high occupancy levels combined with predominantly fixed and annual rent reviews and limited development risk. So let's have a look here just at the share price. Right now it's sitting at $3.26. And let's jump out to 6 months. Let's see how they handled February. So February, they were at $4.29. They crashed down to $2.32. Their 52-week low is at $2.26. Their 52-week high is at $4.51. Their yield is at 6.69%. So let's have a look at this article now that we've got a bit of an understanding of them. Do they have any of their properties? Oh yeah, let's have a look at their property portfolio. Here we have a map. You can see what they've got in. Let's go to Brisbane. We'll go to my hometown. So we've got the Melbourne industrial portfolio. I wanted Brisbane. Is this Brisbane? Why are they showing Victoria here, guys? You gotta love it. Victoria, Broadmeadows, New South Wales, Queensland. Okay, so they've got, is this one it? Cordelia in South Brisbane. Come on, let's see if I can zoom in. Okay, here we go. So let's have a look at some of their Brisbane properties. What do they have here? They've got... This doesn't work very well, does it? Maybe if I just zoom in, I'll know what they have. By looking at it. Okay, so they've got a few around here. SW1. Okay. Yeah, guys, you got to work on your website. SW1, I know that. So, they've got some nice properties around central Brisbane and the Valley. Okay, there we go. What do they have here? Oh, yeah. Nice. So we can see, the type of quality of stock that they have. So by investing in this real estate investment trust, you get exposure to all of these businesses. Now, the question is, will economic changes impact this sector? Will the recession impact this sector? Vacancy rates we've seen have dropped in other cities, except for Canberra, during a recession. Actually, I should have a look at what their exposure to Canberra is. You know what? We'll jump out here. We'll see how many do they have in Canberra, guys. How many do they have in Canberra? Because that could be an interesting one to have a look at. 2 properties. 2 properties in Canberra. So here it is. Okay, that's how it works. Okay, 255 London Circuit. Nice. So, yeah. There we go. So they've got some exposure in Canberra, but most of it seems to be in other cities. Interesting. So let's have a look at this. GrowthPoint Properties Australia has achieved a modest lift in earnings for its 2020 financial year after collecting almost all of its rent bill. So it's collected almost all of its rent bill. And that was the concern, that people wouldn't be paying their commercial rents. But is this just because we've had all these support mechanisms in place? Has the market priced into the valuation of this real estate investment trust, future impacts? Funds from operating, the preferred earning measure in the property sector, rose by 2% to 25.6 per security. Statutory profits after tax, which take into account property gains and losses, fell 27.5% to $272.1 million. Led by Tim Colley, GrowthPoint paid a total distribution of 21.8 per security for its 2020 fiscal year, 5.2% lower than a year earlier. It said its decision to retain a higher level of capital within GrowthPoint was made out of prudence, given the uncertainty caused by the pandemic. Unusually for the sector, though, GrowthPoint has forecast distributions of 20 cents in total for its fiscal year 2021. Although it has withheld guidance on earnings, the stock closed 11 cents or 3.5% higher at $3.24. With a portfolio of industrial facilities and office assets focused in suburban locations, okay, so that could be interesting. GrowthPoint collected 97% of its billed rent during the height of the pandemic shutdowns. Some 89% of GrowthPoint's office holdings are in fringe or suburban markets, which could well prove a boon if major corporate tenants reconsider their reliance on occupying large CBD spaces, according to Mr. Collier. Now that's interesting. We believe the suburban office market could be a beneficiary, he told the Australian Financial Review. We think a lot about the portfolio construction. We obviously haven't gone into retail, which is a very difficult environment. And we've seen that the capital losses that have happened in retail. So what we'll do is we'll have a look here. This is their announcement from the ASX. So GrowthPoint Properties Australia, GrowthPoint or the group, today announces its results for the 12-month ending financial year 20. So funds from operation FFO per security of 25.6 cents per security, 2% up on the prior corresponding period. Financial year 20 distribution of 21.8 cents per security, 5.2% lower than PCP to retain a high level of capital within the group as a prudent measure due to the uncertainty caused by the pandemic. Net tangible assets per security of $3.65. Okay, so that's looking good. 4.3% higher than PCP, driven by property valuation uplift in the first half of financial year 20. Refinanced $400 million of debt, lowering the group's weighted average interest rate to 3.4% and extending its weighted average debt maturity to 4.7 years. Gearing reduced by 210 basis points to 32.2% from 30th of June 2019, well below the group's target range of 35 to 45. Statutory profits after tax decreased to $272.1 million, down from $375.3 million, primarily due to a lower net gain in fair value of investments. So let's have a look at their response. We'll skip over this. I'll let you go through this. I'll link to all of these things I refer to, the articles and things you'll find in the pinned comment. I don't put it in the description. I put it in the pinned comment because it's just easier with the workflow of how I upload all these videos, guys. So you'll see that down below. Just click on references and it'll all be on my website. Or you can find this announcement from the ASX, guys. Their ASX code is GOZ. So the implemented response to the COVID-19 pandemic, prioritizing safety of employees, tenants, and the broader community, provided assistance to severely impacted tenants, granting $800,000 of rental abatements and deferring $2 million of rental payments. Rent collection has remained strong with 97% of April to June total billings collected. And what are they saying here? Rent abatements are not included in total billings. Rent that has been deferred is included. Okay. So what's the total amount of rent that they collect? What is the total amount of rent that they collect? Oh, we can see that later. So our business entered this period on a strong footing. Do they have that up here? Maybe we did. Net profits, value, weighted average. You can go through the finances if you want. Let's jump down to Outlook. Outlook. There still exists a great deal of uncertainty around the impact of the pandemic will have on GrowthPoint's operating environment, including the effect and duration of government measures taken to stop the spread of the virus and assistance to support businesses and individuals. We expect the overall impact of the pandemic on the broader Australian economy will be significant. As a result, we have not provided FFO guidance for financial year 21. However, we understand the value security holders place on receiving distributions from the group and therefore have provided a distribution guidance of 20 cents per share, which we expect to be paid in equal half-yearly installments. He said, while the outlook for 21 is unclear, we are confident that we've put in place the right steps to ensure our business continues to meet the challenges presented by the COVID pandemic. Looking further ahead, undoubtedly, the pandemic is going to have far-reaching implications for our economy and society, and the true impact of the virus will not be known for many years. However, GrowthPoint is well positioned to deliver value to security holders over the long term. The fundamentals of our business remain robust, with a long WALE, weighted average lease expiry, high-quality tenants, and manageable near-term lease expiries. We also have a strong balance sheet, operating liquidity, and ongoing access to providers of future capital. So there we have it, everyone. So I'll let you go through this and the other pieces if you want. They've got their latest, annual report. But what do you think? What do you think? Investing in these type of things? They're all reputable brands in their logistics, and avoiding retail seems like a smart move. And I wonder, What do you reckon, guys? What do you think on 20 cents a share dividends for next year? I suspect we're looking back at this. Let's now that I know how this bloody thing operates, let's jump over here. Let's see what they have in Brisbane. I mean, Brisbane they don't have. It's all central, isn't it? Looks to be. What's this one here? This is a distribution centre. Woolworths distribution centre they own here in Brisbane. WALE is 1.7 years. Yeah, probably not bad. Probably not bad. I can't see them doing too badly here in Brisbane. So, definitely one to consider. Let's jump in. We'll look at Sydney. So in Chatsworth, they've got this one. Let me know if any of you work in these buildings. Give us the down low, guys. So here you go. You know, an office building, freehold. Looks rather schmick. Derby Street, Silverwater. So, could be an interesting business to look at. Well, the impacts of the pandemic on their sector will have to be something to watch. One thing that they raised here that I think is good insight is that businesses may leave the CBD, may leave the posh, expensive offices right in the city, may look a step further out. Instead of getting that A-grade property, maybe going to a B-grade one, a little further out, really putting a dent in their cash flow or their monthly rent bills. What do you think, guys? Let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, and I'll see you all next time.